Good evening, everyone, and warm welcome to webinar on expert advisory on taxation of digital economy, including virtual digital assets, online gaming, and e-commerce. I welcome all the participants, today's speaker, and our honorable chairman, sir, Piyush S. Chajat, sir. Thank you, everyone, for joining us for today's webinar. Today, we will be discussing on the most evolving topic, which is virtual digital assets. So this has been very crucial for each of us as the growing Indian economy is very huge right now. And we need to understand the various taxation aspects, the disclosure aspects, and how we need to advise to our clients. To start off with, I welcome our chairman for Direct Taxes Committee, Piyush S. Chajat, sir. He is a chartered accountant practicing for the last 20 years. He specializes in direct and indirect tax appellate proceedings and arbitration proceedings. He is a speaker on various topics of direct tax, a member of External Committee of Reserve Bank of India's Asset Reconstruction Committee, a vital contributor to WIRC publication on Vivad Se Vishwas scheme. He is also practicing litigation in direct as well as indirect tax. And looking forward to our eminent speaker, Prashant GSG. He is a fellow member of the Institute of Chartered Accountants of India and is practicing in Bangalore. A graduate in commerce, he pursued the Chartered Accountancy course and qualified in November 2006. Actively involved in consulting on matters relating to search and survey under both income tax and goods and service tax laws. He also consults on matters under corporate taxation, transfer pricing, international taxation, and handles litigation and representation of matters at various levels. He is engaged in advising businesses on matters arising under PMLA, Benami, and black money laws. He has presented more than 150 papers under the above laws in various seminars and conferences. He has previously served as co-opted member of Committee on International Taxation constituted by SIRC of ICAI, a faculty at the Bangalore branch of SIRC of ICAI. He has also served as a member of the Finance Advisory Committee of the Karnataka State Cricket Association, a member of Central Taxes Committee of Federation of Karnataka Chambers of Commerce and Industry. Currently, Prashant sir is co-opted member of the Direct Tax Committee of ICI, New Delhi, member of Regional Direct Taxes Advisory Committee, Karnataka, constituted by the CBDT under Ministry of Finance, member of Banking and Finance Committee of FKCCI, member of the Fee Fixation Committee at Adi Chunchanagiri University, Karnataka, as an occasional faculty at Fiscal Policy Institute, Government of Karnataka. He is also a life member of Bangalore ITAT Bar Association and is presently serving as its secretary. Thank you for joining us today, sir. Over to CA Piyush S. Chajarji for your opening remarks.
Very good afternoon. Thank you, faculty, for the day. Dashanji, who is also our co-opted member of Direct Tax Committee, under whom this webinar is happening. Sneha, moderator for the day. All the participants, warm welcome to you on this Thursday seminar once again, wherein today Prashantji will be covering taxation of online gaming and virtual digital assets. Now, when I'm speaking today, I'm speaking from my car. I've just come out of the North Block from office of the CBDT. We have made a pre-budget presentation, a follow-up, I would say. It's a second follow-up pre-budget presentation made to the CBDT channel, and policy representatives from a TPL were also there. Earlier, as I had mentioned, we had already made a pre-budget presentation on 24th of April, wherein we had given 99-point suggestions. We have also again presented today another 10 to 12-point suggestions. I'm sure those suggestions will be looked into it. We had a very purposeful discussion on that, which included discussions on charitable institutions and also 43B subclause H. I'm sure when the budget is now presented on 22nd of July, we look forward to whatever suggestions we have given from the Institute of Chartered Accountants of India. If that could be incorporated in the legislative, I'm sure it would be quite helpful. So it would be a great. Apart from this, as I had mentioned earlier, also last week I had said that we have finalized the implementation guide on the revision in Form 3CD. The same has been finalized. It would be e-launch will be done on 1st of July. That is the foundation day of our institute when we would be completing 75 years of the Institute of Chartered Accountants of India. The e-launch of that particular book would be done. My request to all the members, please do look into that book. You can also place order through our CDS, through our website, if you want a physical copy of that book. It covers all the amendments which have been made in the Form 3CD by way of notification which was issued in March 2024, specifically covering the responsibility and role of an auditor as far as reporting under 43B subclause H is concerned. Apart from that, earlier, as I mentioned, guidance note on audit of charitable institutions in Form 10B and 10BB will be placed before the council on 2nd and 3rd of July. If council approves, we'll release the same immediately, maybe on 3rd or 4th of July. Ebook will be made available to you. You can again place, if you want a physical copy of the same, you can place an order. Apart from that, a very important discussion is going to happen in the upcoming council meeting, which affects each and every member, is in regard to the tax audit, which can be performed by an individual chartered accountant. You may recollect, I had briefed you last week also. The suggestions have already gone from a direct tax committee in this regard. Obviously, I would not like to discuss that suggestions right now till the council gave its decision on the same. But obviously, we had called for we had opened up a Google form and we received 4,087 suggestions from various members, wherein certain members were in favor of increasing the limit of 60, which is currently there for individual chartered accountants for maximum tax audit which they can carry out. So there were almost 50-50 suggestions received. Certain 50% of people wanted that to be increased, 50% of people wanted to be revised. Of course, committee has already taken a view on that. Committee has also considered whether we should put any embargo on. As you may be aware, that though the total tax audit limit today is 60 per chartered accountant, but if you are a two-partner firm, an individual partner can also sign 120 audit reports. So committee also considered whether that restriction of 60 audit to be carried out should also be put on signing of that. That has also been considered, and committee is sent its recommendation to council. Once council deliberates upon that and whatever final decision is taken, I will definitely update you on that. Whatever changes, if at all comes, that will be updated to you. If it remains same, then also you would be made aware of it. So with this, I thought I'll just take a brief. I will briefly update you on what the activities are going on. Most importantly, I wish you a very happy Foundation Day, which is coming on 1st of July. Be well, do well, enjoy well. It's a Chartered Accountants Day. It's a Professionals Day because the same day is also shared with the doctors also. And obviously, after that, 1st July, it's an important month for you. Most of us individual practitioners would also be involved in the individual tax filings. So next month onwards, we are trying to concentrate because all this you see will so filings for 4th of July, and hereafter unconfirmed news is that it would come, but the grapevine says it should come on 22nd July. So if it comes up, we'll also have some discussion on this webinars. We'll try to get some faculties and also have a live budget discussion on this webinars. So thank you very much once again. Have a very happy learning. I would thank Prashant ji and Sneha ji for joining of this committees. Thank you very much, Sneha.
Thank you, sir. Thank you for keeping us abreast of all the latest updates and changes. Thank you to start with such a wonderful opening remarks. Now the session is open for you to deliberate, sir. You can take over, Prashant, sir.
Good afternoon, all. At the outset, I thank the DTC of ICAI for giving me an opportunity to share my views on income tax implications on VDA, e-commerce, and online gaming. We are indebted to our parents for life. We are indebted to our guru for the way we live. I take this opportunity to place on record my deep sense of respect and gratitude to my mentor, CAS Venkatramani, who has been a guiding force and factor in my endeavor of profession. Also, my respects to CAD Devraj and CA Shankar, who mentored me at various stages of my professional career. To say beside and set the tone down, how the digital ecosystem has grown in the country, especially in the last decade or so. This is far more than what was imagined. So if you look at now, how many transactions were happening online in financial year 12-13? It was about 162 crore transactions. Now, from 162 crore to jump to 14,726 crores based on the RBI data for 2024, which means what is the pace at which online transactions have grown? Probably this particular pace beats every other sector in terms of volume and in terms of growth. And all of us are aware as to how the digital India is taking shape, because right from a vendor selling tender coconut on the street to your local chaiwala to your chat bandar to the biggest supermarkets, everybody now is in the Digital India initiative, wherein digital payments are a reality, digital currency is there, people are using more and more digital transactions. This has been the digital infrastructure is grown to such an extent that probably it's hard imagining for somebody who's now entering into this tech world, or probably the students who come out now after graduation. Probably it will be a life for them. They can't imagine without having a digital India. Take, for example, somebody who's just graduated now. 10 years ago, when the Digital India initiative came in, that particular boy or girl would have been in high school at most. So for them, their life has begun with internet and digital transactions, and I'm sure it's only going to go up further. And how was it achieved, or did it come so naturally? Because you had this Jandan Aadhaar mobile linking, wherein which enabled bank accounts to be linked to mobile to Aadhaar, so that there is transparency and accountability at all ends. At the same time, even for the direct benefit transfers happening from the government, this was a good initiative. And now, how does this impact? This seamless integration across departments or jurisdictions, which makes services available real time. So this would only result in having a better business infrastructure environment, and of course leading to doing ease of doing business. Once your ability to conduct business happens in a simplified environment, how much you're going to offer to your customers is only going to improve. So therefore, one of the online portal providing data points out that India has about 1.2 billion internet users, and it's going to be about 1.6 by 2050. Therefore, obviously, India is second in online market after China. Yes, both India and China are one of the most populous nations in the world. Nevertheless, the pricing at which an Indian internet user today is getting data compared to what these so-called developed countries provide is the huge difference. Probably we are paying, I can say, negligible amount of money to have 1 GB of data in India today, whereas it costs way higher, especially in US and UK, which had these services from many years ago. So therefore, how the transition from a completely cash economy to partial cash to partial plastic, when I say it was credit cards and other things for the last 20 years or so. Now people are going beyond it to say there's no need to absolutely have cash with them, and everything is happening through a mobile phone. So therefore, and in the new age, you had assets which are always real. Now you have digital assets, you have virtual digital assets. So, what are these virtual digital assets? See, there are certain technical technologies which will come in. I would admit at the beginning of the webinar itself that I am not an expert on blockchain, crypto, and the technology behind it, but I'm only trying to make out, like all of you, do my bit of studies in that, and to understand as to how they function. But the focus will be on the taxation element of it, because at the end of the day, income tax law does not distinguish as to how complex the particular asset is or the particular technology behind it is, but all that it requires for the Income Tax Act is to tax it because it has been made part of the statute. And because at this point in time, I have to tell you that equity and hardship are canons unknown to taxation law. So therefore, just because it's difficult to understand or it is causing a little hardship, it does not mean the same won't be taxable. So therefore, getting on to that, the virtual digital assets are subsets of digital assets transacted on a blockchain, such as the non-fungible tokens, crypto, and other virtual assets. How did this happen? And what is there any definition which is there about VDA and how it goes on? The FATF has given a definition for a virtual digital asset to mean a digital representation of a value that can be digitally traded, transferred, or used for payment. But it does not include digital representation of fiat currencies. And now this leads us to say, what is this fiat currency? It's no doubt a government issued currency, but there is no backing of that particular thing, which gold or silver, but only by the government. Most paper currencies such as Indian rupees, US dollar, etc. So the sovereign guarantee, what we talk about when a particular currency is issued by the any country or state. Now, how does this VDA pan out in the real world? And what distinction does it have with things? And how our country has looked at these assets in the past 5 or 6 years? And what are the steps that the regulator in our country has taken steps to find out what they are, how they're being traded, how they're being sold, how they're being taxed. So you had to evolve a mechanism, because it is like in the original Telegraph Act, the reference was there to, there was no reference to the typewriting because it was only for the handwriting. Then, because the typewriter came a little later, you had to presume that any other mode, that is handwriting and typewriting, should be included in that particular thing. Like similarly, when such a new thing emerges, it's but natural that the regulator has to conduct their own research, find out the global best practices. It's not that whatever is happening on a world stage will be replicated in India. No, we have to customize to suit our needs and our demography, our population, and keeping in mind our taxation laws. Here, the key difference between a digital asset and other files lies in whether or not the file adds value to the person who owns it. So therefore, we'll get on to how it has happened, what has happened. And like always, we need to have a definition. We will discuss it, the slides, a little later. But you had these virtual currencies, and El Salvador is one country which accepts cryptocurrency as a legal tender. So out of virtual currencies, crypto is only one such thing. And they're used for making payments, for transactions. The world over, the issue that most enforcing agencies encountered was these cryptocurrencies were being used for trading in the dark net, and other activities which was difficult for the enforcing agencies to follow up with. It was happening remotely, happening in a way which was there's no transparency. We would not know what's happening. But because of the technology in it, the blockchain technology, where there will be the trail as to what happens, but nobody knows who's doing it. So therefore, RBI for the last decade or so has been cautioning, issuing various notifications as to how they're not virtual currencies. And in 2018, they notified that entities regulated by RTA shall not deal in virtual currencies or provide services. And see, you had our judiciary being very strong and how they have not overstepped and other things. Supreme Court of India in 2020 lifted the regulation imposed by the RBI. But they also stated that the RBI is very clear that they have not banned the VCs and the government is not able to take a call different. At that point in time, it was as to what call the government had taken in 2020 about these virtual currencies and the things. But in enter 2023, we were ready because in 2022, the finance minister announced that India will have its own digital currency, but there was nothing to depict that the cryptocurrency is getting banned. But by the time 2023 had come, due to the phenomenal increase in transactions in these virtual digital assets, there had to be a regime to brought in for taxation of these BDAs. So 2022 Finance Act, originally through the Finance Bill and later through the Finance Act, introduced 115 BBH, 194S dealing with TDS, and the definition under 247A. Now, this particular definition may be much easier for a software professional to understand rather than a chartered accountant who's into traditional practice. Nevertheless, we have to make an effort to understand what it means, because ultimately, based on our understanding, we have to interpret the law and to examine the taxability. Any information or code or number or token. So this should be information or code or a number or token, but it does not include Indian currency or foreign currency. Generated through cryptographic means or otherwise. Now, look at this particular word carefully, which is that any information or code or number of token not being Indian currency or foreign currency generated through cryptographic means or otherwise. Now, this leads us to the question, what does this term otherwise mean here? How do you understand the term otherwise? What does the word otherwise qualify here? Is it qualifying any information or code or number or token or otherwise? Or code or number or token generated through cryptographic means or otherwise, to say that it can be generated through any other means apart from the crypto? Because what is cryptography? It is a process of coding information so that only a person a message was intended to can read it. Which means if I send out a message and if I want only Piyush Bhai to read it, there's a particular process of coding information that only the intended recipient would be able to read it. That is, in layman's terms, what is cryptography. But here we are dealing with what is a virtual digital asset, and when they've said 247 of the A defines virtual as digital asset to mean the following, you have to understand how this particular word otherwise fits in here. Because you had a position where you had the Supreme Court in the case of R&B Falcon 301 ITR 309. That matter was dealing with fringe benefit tax, which is no longer there now. But there, the court did not get on to the interpretation under the FBT, but they came back when they were discussing the terminology used and then how they have to interpret. The court observed that the words or otherwise, when they have been used in a general phase as an enumeration of particulars, are commonly restricted, are commonly interpreted in a restricted sense as referring to such other matters as are kindred to the classes before mentioned. Does this mean ageism generis? For example, now, one simple example I keep giving people about ageism generis is you had an airline which had a board saying cats, dogs, and other similar pets are allowed. When they say cats, dogs, and other similar pets, can one take a contention that, look, I have a cheetah as my pet, a small cheetah cub, it's my pet, can I bring it? The airline has that board saying cats, dogs, or other similar pets. So, when you're wanting to interpret that particular rule to say what are other similar pets, you cannot say a similar pet would be in the nature of a dog or cat or is something else. Can somebody say, I have a cheetah cub as a pet? Then you have to interpret it to say, when they're talking about cats, dogs, or other similar pets, it has to be animals which can be domesticated, which can be reared as pets. Similarly, therefore, the cheetah cub won't be eligible to fit into the definition of cats, dogs, or other similar pets. Similarly, here, while using the term otherwise here, it is any information or code or number or token generated through cryptographic means or otherwise. You recently had the Supreme Court in Mansukh Dyeing and Printing Mills discussing about this word or otherwise in the context of 45(4) of the Income Tax Act, dealing with dissolution or otherwise of partnership firms. So then the Supreme Court said the word otherwise used in 45(4) takes into account not only case of dissolution, but also other cases. When they say or otherwise, they meant that including reconstitution of partnership, transferring of assets in favor of a retiring partner would get covered. Obviously, this view was taken a little earlier in by the Bombay High Court in A. Naik Associates. But after the Supreme Court came up with that in Mansukh Dyeing and Printing Mills, we know how the law evolves, and then you had the amendments in 45(4) to clarify the intent and to give more better understanding, I would say, as to how 45(4) operates, especially after 45(4) and 9B coming in. Similarly, when we're talking about here cryptographic means or otherwise, it should be understood in a manner that you can have some other aspects also coming in, but we must also read the latter part of the definition to say, by whatever name called, providing a digital representation through cryptographic means or otherwise, with or without consideration, with the promise or representation of having inherent value or functions as a store of value. This is why I tell this was more like a definition in the real technical world, where normally we are not exposed to this in the taxation laws, including its use in any financial transaction or investment, but not limited to investment scheme, and can be transferred, stored, or traded electronically. So, very elaborate definition of VDA in terms of what it is. This 247A, small a here. Second class under VDA is any non-fungible token or any other token of similar nature by whatever name called. Again, a non-fungible token, NFT, which are popularly known as, or any other token of a similar nature. And the other class is any other digital asset the central government has got the power to notify in the Gazette. So now we have to understand what these NFTs are. What are them? Cryptocurrency is definitely one of them. It falls under the definition of virtual digital assets. Cryptocurrencies generally run on a public distributed ledger, which is called as a blockchain, which has a record of all transactions updated and which are held by the currency holders. And these units of cryptocurrency are generated through a process which we understand is known as mining, not the traditional mining that we are accustomed to, but is also known as mining, which involves a computer power to solve complicated mathematical equations that generate coins. So, therefore, in 2018, in the 2018 budget, the then finance minister had stated that India will not accept cryptocurrencies as a form of legal tender. But he had understood, the then finance minister understood, that the benefits of blockchain technology must definitely be used for development of the country. So, therefore, when a new technology comes in, we must be able to take that in our stride, and which is why I said in the beginning of it, to customize to our usage. Here, definitely, blockchain is a technology which is definitely useful, which leaves behind a trail. It can't be tampered with so easily. So the system will be strong enough in the digital eco space. And again, in the IT infrastructure point of view, this will be a very safe way to have the transactions. But one question that arises is, what value does a cryptocurrency carry? What is it backed by? When you can't print currencies like the way you want, because you need to have sufficient gold reserves. Otherwise, the inflation would be in numbers which we can't spell out. All of us know what happened to Zimbabwe a few years ago. I think they introduced a 1 trillion Zimbabwe dollar note or something, probably, and that could have been used to buy a loaf of bread. So you can imagine what was the position of Zimbabwe then if you keep printing currencies. Now, coming to cryptocurrencies, it has got no legislated or intrinsic value. It's like a transaction between people. You have a buyer, you have a seller, and it's more like the price bargained to between the parties. We had this old Supreme Court judgment to say what is full value, what is consideration. They say what is price agreed between the parties for capital asset, capital gains. That was amended later on, fine, but the price agreed to or bargained between the parties would be treated as a consideration. Similar thing in cryptocurrency. There is no intrinsic value attached to it. So therefore, subsequently, once we've decided that it is not going to be part of our currency, SEBI said they were neither securities nor commodities, and that they would not have jurisdiction over these crypto exchanges. So therefore, the law had to evolve as to how this happens and how the transaction and works and how the taxability. How does a cryptocurrency transaction work? This occur through electronic messages that are sent to the entire network about with the instructions for this, and it will have the e-address of the parties, the quantity of currency to be traded, and a timestamp, which means it is probably once a miner in this computer terminology solves a complex mathematical equation, and the others in the particular network check the solution and reach an agreement that it is valid. The new block is added to the transactions. So it's not that it takes about 6 blocks of transactions, is what I understand from my reading in the big domain, that so that users may be certain that the transaction is successful. Therefore, the system is not instantaneous because the transaction sits with a group of other recent transactions waiting to be compiled. It's more like a batch processing thing. So then this information from the block is turned into cryptographic code, and then different people would compete to solve that code. Therefore, it's a little complicated in terms of how it works and how it functions. But what we are necessarily wanting to understand here is the taxation element of it, without getting on to what they are, because now we have these three categories here: any information, code, or number or token generated through cryptographic means or otherwise, NFT or any other token of similar nature, third class, which will be notified by the government. But blockchain is a technology that is capable of supporting various applications. to multiple industries spanning over finance, supply chain management, manufacturing, etc. So therefore, it has its own advantages and how it moves on. Now we have to see what it is. Again, these are the 247A continues. Now, what are the mandatory conditions or requirements for something to classify or be classified as a cryptocurrency, virtual digital asset? It should not be an Indian currency. It should be generated. Should provide a digital representation of value. Comes with the promise or representation of having Indian value, and it should be able to be traded electronically, stored, and transferred. These definitions I will not really get onto this because they refer back to the FEMA. Because though El Salvador became the first country to treat it as legal tender, because now it becomes a foreign currency, now that cannot be treated as part of VDA here. And before we get on to what the CBDT excluded, it's imperative to understand what these NFTs are. We've read about it, saying how the NFTs have been traded. Fungible means something which can be replaceable. So when you say non-fungible tokens, that implies that it cannot be replaced. NFTs are again unique cryptographic tokens that exist on the blockchain and you can't replicate it. It can be a digital or real world items like artwork which are capable of being coded or brought onto in the NFT form. They can be traded in exchange for money, cryptocurrencies. You can have exchange between two virtual digital assets or these NFTs, which happens. But the two NFTs from the same blockchain may look identical, but they are not interchangeable, which means each has its own unique identity, which is represented in the blockchain, and it is not interchangeable at all. You may have hundreds of, for example, photos. Each one has got its unique ability. You have the same photograph, but it will have 100 different things. It can't be interchangeably used because each one has got its mark on the blockchain technology, that it moved on from one to another and that still continues. And every token has an owner. And who is the owner of it is publicly available. So even if you have 5,000 items of the same NFT which are minted, take for example what happened with Amitabh Bachchan's photograph. It was sold for about 7 crores, his collectibles. It included his photographs, the poems by his late father, and some vintage posters that he autographed. Those things. Assuming you had multiple sets of those posters also, each has got a unique identifier and can be distinguished from the others because it is only interchangeable, will look identical, but it is different in terms of how an NFT is depicted on the blockchain technology. You also had the former CEO of Twitter, now known as X, who sold the first tweet that he made on the platform. He created that into NFT and it was sold for about 3 million. So you can understand the extent to which they have gone about. Now, coming to India, Tamil Nadu has got its own artificial intelligence generated NFTs representing the state, titled Netru, Indru, and Nalai, meaning yesterday, today, and tomorrow. The NFT showcases Tamil Nadu's past, present, and future, which means we are a country, we are moving forward in the right direction in terms of digital economy, digital transactions, and how this is going on. Now, as usual, once you say a new class of asset is created, you're wanting to tax it. The next question that arises is, look, you're talking about any information code or token, NFTs, any digital currency. Now, the issue immediately arose as to what happens to this gift cards. vouchers. Because all of them, in a sense, are virtual assets, have a definitive value or digital representation. They can be exchanged or traded. You can be transferred and you'll get money in return. So therefore, CBDT wide notification 74/22 saying that gift cards or vouchers or discount vouchers, they are not VDA. Next issue arose was what happens to the reward points on your credit card? This points given by your petrol bunk dealer when you keep refueling at the same station. The loyalty incentives that your airline partner gives you, or the hotel partner, or the taxi aggregators give you, which can be redeemed for host of things. For example, if you know about this airline portal makemytrip.com now, which has hotels, flight bookings, vacations, everything. But if he is giving you some loyalty or incentive points, you can redeem it for a host of things, right? From saloon services to buying of items which are used for day-to-day usage, like refrigerators, televisions, everything can be purchased or redeemed for. So whether these mileage points or loyalty incentives form part of VDAs, they said it does not form part. The CBDT clarified it so that they didn't want any further complications. Then subscription to websites or platforms or applications, because again, you're doing it online, it can be traded, it's information. They said you're subscribing to a platform or application, it is outside the ambit of being called as. Then you have the second notification which came. They said the VDA shall not include a non-fungible token whose transfer results in the transfer of the underlying tangible asset itself. To give an example, assuming you have an NFT of a painting, a non-fungible token created of a painting. When you're selling that NFT, if you're also selling the original painting, that results in the transfer of the underlying asset also. Then NFT, though you sold it, because the underlying asset is getting sold, the underlying asset and that particular NFT will be treated as a capital asset. If the underlying asset is not transferred physically, but if the ownership remains and only the NFT is being transferred, it becomes a non-fungible token. Being the non-fungible token will be classified as virtual digital asset for the purpose of 2 subsection 47A and consequently the taxability. Because how the VDA has gone through and what it is for various professionals to understand. But taxation is something that we will be clear as to how they have to manage it. We'll go on to cryptocurrencies include Bitcoins, Dogecoins, stablecoins, Ether, and they are payment tokens which are backed with real assets. So, like any currencies or virtual digital assets, this also had its up and downs. The value of Bitcoins fell considerably. A lot of people lost money, but now again it's gaining prominence. So, therefore, now they're here to live. So, better make peace with it. And now we are sure that we are talking about the taxation and how it happens. How is it created? How are this creation and trading of virtual currencies happening in the virtual world? Mining, as I said, it is process by which new bitcoins are entered into circulation. Airdrops, these are like your free vouchers or things to say entice you into buying like that. They give a small quantum of virtual currency to the wallets of the active members of the blockchain technology. sometimes for free, or sometimes if you're getting value worth 100, you may end up paying only 5 rupees for it, like that. That 5 rupees is service fee. Or it may be a return service that you would take this 100 rupees from me, but you would publicly acknowledge that, thank you so and so, you did this for me. So therefore, like we have in shares, the IPOs, we have the ICOs here. You will have the initial coin offerings coming in. Where are they stored? In crypto wallets. We are aware of your Amazon wallet, Flipkart, Paytm, Airtel now. These are what you have, where you store your coins or currency there, and then you use it to purchase on those particular platforms. They are stored in crypto wallets, which are physical devices or online software, which again used to store the private keys to the cryptocurrencies securely. Again, for this also you have people who manage them, who offer you wallet services. And as usual, like in any business, you will have a counter broker to find potential token purchases. So when you have a market, you'll have a buyer, you'll have a seller, you'll also have a broker. Now, now we'll come to the actual income tax and taxability and the issues concerning as to how it goes on. 115 BBH. What was the position of virtual digital assets before 115 BBH? Because 2 subsection 24, the definition of income is the inclusive one. So all sorts of income is taxable because law does not distinguish between legal, illegal income, new streams of income, or which was unheard of in the past. So therefore, the law had to be interpreted then based on what it was then, and which means even before a separate scheme of taxation was brought in for VDAs, it was always getting taxed in different heads depending upon it was a capital asset as capital gains or business income or other sources as the case may be. But after 115 BBH, income from transfer of any VDA shall be taxed at a flat rate of 30%. Now we come to 115 BBH. With total income of an assessee includes any income from transfer of any virtual digital asset, notwithstanding contained, which means again it's a non-obstante provision. The income tax shall be aggregate of the amount of income tax calculated on transfer of VDA at 30% and amount of income tax which assessee would have been chargeable had the income been reduced by the amount of VDA. Fine. Till such time, we are fine here to talk about what is taxable. We've understood what is virtual digital asset. I've made my effort to read up and come out with what different terminologies are so that people also may be familiar. I'm sure there will be many more knowledgeable people in the audience will be able to throw more light on all these technical terminologies and how to understand them better. Nevertheless, continuing with the taxation of them, subsection 2 is the most important one. Subsection 1 talks about it is taxability and the rate. Subsection 2 in 115 BBH is, I would say, a little draconian because it says no deduction in respect of any expenditure other than cost of acquisition, if any, or allowance or set off of any loss shall be allowed to the assessee under any provision of this act in computing the income. So, there is no expenditure or allowance or set off of any loss. Only the cost of acquisition with respect to the VDA is allowed as a deduction from the income what you're wanting to bring it to tax. If you feel that this is not enough, you have subclause B in that, wherein no set off of loss from transfer of VDA, which means if you're having two separate virtual digital asset and you sell both of them, on one you incur a loss and one you incur a profit. Mind you, we are now in a non-obstante provision, self-contained code 115 BBH. On the VDA that you made profit, you will have to pay flat rate of 30%. And on which what you have made a loss, it remains a loss, you have lost money. There is no set off available for the VDAs from one VDA to another. even though it has happened simultaneously together. Say, take for example, I told you two photographs which are treated as NFTs. One sold for a higher price than what you bought it for. The other probably would not fetch the same price. Even then, it does not matter. There is no set off of loss available, which means it makes it a little tougher. If you're VDA, 30% flat rate, accepting cost of acquisition, nothing else is allowed. And loss from one VDA also cannot be set off against gains from that. Now, because loss cannot be set off, carry forward is automatically prohibited. Now, an interesting question arises as to what happens to the loss which was, I would not say generated, but loss which was incurred prior to the introduction of 115 BBH. Because mind you, the virtual digital assets were there. It was being offered to tax under different heads depending on the stream. If you're capital gains, if you're treating it as a capital asset, you would have offered it to tax as long term or short term depending on the period of holding. And similarly for business income, if you're in the business of trading in those virtual digital assets, you would have offered it. If you had you encountered a loss then, which in the normal course you would have carried it forward as loss from business. Whether it's allowed to be carried forward, does the law allow it to say after 1422, one view which should ideally be followed is any loss generated after 1422 because of a specific code coming in under 115 BBH will anyway never let to be set off. But my opinion is that if there's a loss which is generated under a different stream when the self-contained code of 115 BBH was not there, it partook the character of regular business income or regular capital loss as the case may be at that point in time. So therefore, my opinion is that if there's a loss which was incurred or generated at that point in time, may it be as loss on transfer of capital asset or business loss, I am of the firm opinion you should be able to carry forward and set off because 115 BBH can't presume today that the transactions that you undertook then are part of VDA because the section was not there. That's my view. There may be different views on the allowability and carry forward and allowability of set off for the future years. What happens to exemption under section 54? Because 2 subsection 47 talks about transfer as defined in 2 subsection 44 shall apply to virtual digital assets also, whether capital asset or not. But if headwise computation is permissible, then you will be able to claim 54F. If not, 115 BBH is standalone. You will offer income under a separate head, I think chapter 12, which talks about tax on incomes, a separate chapter. So when you are offering it in a chapter 12 and the flat rate is 30%, whether this taxability on one hand, can you claim exemption there? You have to see. Because if the headwise I repeat, if the headwise computation is permissible, I think we should be able to attempt to claim 54F. Rebate definitely is allowed for income from gambling, VDA, online gaming lotteries. Next question is whether the maximum amount not chargeable to income tax being say 2.5 lakh rupees at present. Do you have this benefit here? I'm afraid no. 115 BBH is a standalone section which taxes you from the rupee 1 at a flat rate of 30%. So the 2.5 lakh limit will not apply here. Under income from other sources, 56(2)F applies when a person receives any property other than immovable property without consideration. FME exceeds 50,000 and then you have the consideration exceeding 50,000, the aggregated. We are clear about what is 56(2)10. But the amendment in 2023 happened to say the expression property shall have the same meaning assigned to it in clause D of the explanation to clause 7 and shall include virtual digital asset. Because the Finance Act 22 included VDA within the scope of property. So when they talk about property, which was in 5627, and it shall include a virtual digital asset, which means the income would be taxable even under this particular head when you talk about headwise computation of VDAs. When they talk about any property other than immovable property, VDA is brought within the ambit of being treated as a property. Now, like most sections operated in income tax, about taxability of income on one hand, the second stream, government is always interested to generate money in advance. Of course, you have advance tax provisions for that, and you have TDS, which was introduced way many decades ago to say on the concept of pay as you earn, pay taxes, I mean. So, 194S has been introduced with effect from 1/7/2022 to talk about any person responsible for paying to any resident any sum by way of consideration for transfer of a VDA shall at the time of payment of credit so and so deduct an amount equal to 1% of such sum as income tax. You have the exceptions there as to who will not be and at what threshold limit. They brought in the concept of specified person here. If it's payable by specified person, then the limit is 50,000 in the financial year. If it's other than specified person, the limit is 10,000. So, what do you mean by specified person here? Individual HUF whose turnover and receipts is 1 crore or 50 lakh respectively for business and profession, and individual or HUF not having income under the head profits and gains of business or profession. That's specified persons. So we have to understand from this point of view as to on the aspects of TDS now, where we stand, what is the I would not say legitimacy, but definitely talking about how they're mobbed up, because for 2022-23 we had the figures from the press release. TDS on payments about transfer of VDA was about roughly about 158 crores up till 20th March 2023. And I'm sure it would have, if not equaled it, probably close to being that number again for financial 24. So therefore, the moment you have TDS coming in, again, accountability, transparency, you know what's happening, the money is getting paid to the government at the earliest. We have to now see what is happening, and you have standalone 115 BBH, you have TDS, and now you have penalty. So if you are again failed to deduct, 271C would be applicable. CBDT has come out with a circular 13/22. One thing on the legality of the circular is binding on the officers of the department, that is only on the revenue. It is not binding on the assessees. The assessees can use the beneficial provisions in the circular, but it can't be forced on them to say there is a circular and now it has to be used in. It is not permissible. One of the questions which came up was, who is required to deduct tax when transfer of VDA is taking place through an exchange and payment is made by the purchasers to the exchange directly, and then it goes to the seller directly to the broker. So the CBDT has clarified that If the VDA is being transferred, is owned by the person other than the exchange, the brought about as to how it happens. The exchange would be required to credit or make payment to the owner of VDA. And because there are multiple layers and players in this particular transaction, CBDT has clarified that tax may be deducted under 194S of the Act only by the exchange, which is crediting or making payment to the seller, that is the owner of the VDA. In case where the broker owns the VDA, it is the broker who is the seller. So the amount of consideration being credited or paid to the broker by the exchange is also subject to TDS. You will have an issue where the credit or payment between the exchange and the seller is through a broker, and the broker is not the seller himself. Then the responsibility to deduct tax shall be both on the exchange and the broker. So to avoid double taxation or double deduction of tax, you can have the exchange and the broker can have a written agreement as per which the broker alone may deduct the tax, and then the exchange will have to furnish a quarterly statement in Form 26QF for all of those transactions which there's a payment or credit happening between exchange's seller through a broker, and that the broker has done TDS on that. So therefore, these are which came in. Now, the buyer may not know whether the VDA being transferred is owned by the exchange or not. He will not, because he is buying it, but he does not know who the owner is. Here, because the buyer does not know, the agreement will be between the buyer or his broker as an alternative with the exchange, saying that in respect to all of these transactions, exchange would be paying the tax on or before the due date, and the exchange would be required to furnish a quarterly return 26QF for all these transactions. So therefore, they're wanting to bring some clarity to this purpose to say how this happens, and this is also one of them in terms of ease of doing business. You will also have these transfers happening for items in kind. Then how does it happen? The other person whose responsibility includes payment of deduction and payment of TDS to the credit of central government has to ensure that the tax which will be payable is discharged. Because, for example, take it here, the virtual digital asset, one of them is being exchanged with another virtual digital asset, which means both the persons here is a buyer as well as a seller, because there's an exchange happening on a whatever value. So in one situation, the seller has to deduct tax and pass it on, and in the other case, vice versa will happen. So even for this, they can have an agreement to say the other VDAs can then be exchanged, so that this has to be reported in the TDS statement along with the challan number. Again, this went through, the board issued the clarification saying that if the exchange is deducting, fine. Exchange would then deduct tax for both legs, that is for the buyer and seller as buyer and seller respectively. And then the benefit for the buyer and seller is they will not independently have to follow 194S for that. To say he's a buyer, he has to deduct, that thing is not applicable. You will have a situation where exchange is opting for deduction on such transactions. There's a possibility that the TDS done is also in kind. It needs to be converted to cash before it is deposited. Even for that mechanism, what has to be done, they have brought out. The exchange would deduct tax in the pair being traded. This is as per the CBDT circular, what I've posted here. So the trail of transactions evidencing deduction of 1% for every VDA to VDA trade shall be maintained by the exchange. So exchange shall immediately execute a market order which can easily be converted into INR. So this will ensure that tax written in the form of non-primary VDAs is converted to an equivalent of primary VDAs, which have a ready INR market. Timestamps are very important so that if the taxes are withheld in the primary virtual digital assets, the exchange would not follow this step at all. And you have as to how it goes on, what is the hours, the accumulated balance of the primary VDAs, is a time frame which happens. So these are how the accumulation happens and the conversion into cash happens. You will have a overlapping section under 194Q and 194S. So if tax is deducted under 194S, 194Q would not be applicable. Again, this is the CBDT also says without going into the merit whether VDA is goods or not. So they're not wanting to get there, but they're saying once 194S has been made applicable, 194Q would cease to apply. Like the issue on gross basis, including GST, right from our service tax days, this issue was there, whether TDS is applicable on the inherent value of services or including service tax or GST as the case may be. Now it is net of GST amount. There is no doubt on that. If you look at the next one, in transactions where payment is being carried out through payment gateways, there may be tax deduction twice. If a person is required to make a payment to the seller, he makes payment of 1 lakh. On these facts, liability to deduct may fall on both. But the clarification is the payment gateway will not be required to deduct tax on transaction. The tax has been deducted already by the person who is required to make it. Though it is happening through payment gateway, if the person who is required to make the payment, or rather who has to make the deduction has done it, then no further TDS is applicable here. Again, how do you do it? Like you have form 26A and 31A as to is directed, paid, and upload. Some such thing will come. Now we are talking about only taking an undertaking, but I'm sure the systems and forms will get updated to include these things to say it is not sufficient that you say that he is directed. He must also confirm to that and probably file that statement only then. That's why it's going to happen. Income arising to a non-resident and transfer of VDA. Obviously, if the asset is in India, the income arising to a non-resident is subject to 911 and DTA. But generally, to the law that applies and as to how the situs of an intangible asset, Delhi High Court in 388 ITR 617 said that the legislature, wherever it wanted to specifically provide for a particular situation, they have brought it so, saying that from where the share derives directly or indirectly, because there is no such provision for intangibles as trademarks, logos, brands, etc. We have to understand that it is subject to where the situs of the owner of an intangible asset is where we should say that the situs of the intangible asset is. I don't think we will get on to GST on VDS because we are already at 5:10. We will have to discuss online gaming and then give up time for question answers. Sneha, my time is still 5:30 for that, right?
Yes, sir, you're right.
Yeah. So you had Prevention of Money Laundering Act.
You can also extend, sir. You can take another 10-15 minutes if you want to.
Okay. So we'll stick to what's there, then we can take up other things later. Now, next one would be the online gaming. This again is a booming industry worldwide. So what was not known probably 2 decades ago to a large extent or large population, now this is the almost the in thing. as to, of course, the India will have obviously anything in high numbers because of our population, but the average revenue per user for this online games in India is still lower because people would not really uh, do it. But what we have to understand is how we are lapping up technology and how time and again, we are moving in the right direction in terms of how it is being remarked as. The Prime Minister also had an occasion when he was addressing a post budget webinar. He spoke about uh, how this is a booming sector, the animation, visual effects, gaming, and comics, and then how India is about in the top 5 markets in the world. So, therefore, the PM also had a interaction with top gamers in India, serving as a platform to engage with top Indian gamers. It is done as objective to understand the industry and scope in India as to what we can do. It will always be good that a game developed in India, if it's sold outside India, obviously the Indian economy would boom. But you also need to understand how the legal framework of online gambling in India is. That is very old act, 1867, Public Gambling Act, 1867. At that point in time, who would have even envisaged that something can come up like this? So, there's only physical gambling, and online gaming is outside the purview of that. And one important thing is Section 12 of the Public Gambling Act states that the Act shall not apply to any game of mere skill wherever played. So, what is a game of skill? Take, for example, in the card games, the usual suspects, like your Rummy, which is a very popular game, courts have held that it is not a game of chance, but it is a game of skill, because the court said that it requires people to memorize what cards have to be played and who has played which card. So therefore, the court has held that Rummy is a game of skill and not a game of chance. But if you're merely gambling without skill involved there, that will be under the purview of Public Gambling Act, Consumer Protection Act, have the Information Technology Act, which has taken tremendous strides in terms of how the steps towards making internet open and safe, the same time accountable. So therefore, a lot of framework for online gaming, including where actual money is involved. And people are playing games, it's not merely for entertainment purposes. It's now developing into an industry by itself where people are investing money and you have tournaments being conducted. People are taking money from winnings. Therefore, it was high time that you had to bring in. Yeah. Now, as to how Indian different states look at with this online gamings. Recently, the Karnataka government has amended its gaming law to prohibit online gaming, betting, and wagering. Telangana gambling in 1974, the amendment in 2017 prohibits any risking of money on uncertain event, including games of skill. So, despite games of skill not being treated as gambling, in Telangana, even it is prohibited. Maharashtra has banned casinos and online gambling. Goa, Daman, and Diu thrives on tourists and other things. They have brought in their own amendments to say, and games in onboard vessels offshore may be notified. So they have a different subject altogether. This is what I was talking about. Rummy, poker, horse racing. We are aware as to what is a game of skill, what is a game of chance. Where if any application of mind and expertise is required, you will treat it as a game of skill. If it's for a random thing where you need not have any control on how the game is happening, or nobody has control on how the outcome, and it's completely luck favoring you, then it's a game of chance. But one thing you have to understand is, even in a game of skill, it will come with a bit of game of chance. Take, for example, poker or rummy, for example. When different players compete, it may look up as game of skill, but it definitely has got its element of chance in that. But merely because it has a small element of chance in it does not take away the main character of being a game of skill. Recently, we had Gamescraft Technologies in the Karnataka High Court, and they say that a game of chance played with stakes is gambling and hence taxable. Game of mixed chance and skill is gambling only whenever it's substantially and predominantly and a game of chance and not of skill. And this particular judgment of the Karnataka High Court has been stayed by the Supreme Court. But you look at the old Supreme Court judgment in state of Andhra Pradesh versus Satyanarayana, which I'm sure all of you are able to see it on the screen. Supreme Court said Rummy requires certain amount of skill because the fall of cards has to be memorized, and the building up of Rummy requires considerable skill in holding and discarding cards. No doubt, where cards are shuffled and dealt out, there is an element of chance, but it is dependent upon how the cards find their place in the shuffled pack. Only because of this, it cannot be said that it is a game of chance. This was way back in 1968. So the courts were burdened with these issues, saying whether card games are games of skill or game of chance. You had this Dream 11's case, wherein, and I'm presuming that most of you are aware as to what this is when you've seen various ads on it, picking a cricket team of all the players put together, and who will, depending on how they perform in that match, the points would get accumulated, and then it may also result in winnings, which may be in winnings in tangible form, that is money. It definitely, for Dream 11's case, SLP has been dismissed by the Supreme Court. It depends on the user's excess of skill based on superior knowledge, judgment, attention, because it is not about what happens that day, because when you're selecting that particular team there, you need to know as to how they play, the pitch conditions, so on and so forth, and the opponents and their skill sets and the present form of the player. Therefore, they said that online fantasy sports gaming are not gambling but games of skills. You have how the taxation has evolved. You had this casual and non-recurring income. You had exemption in subsection 3 till 70 to 73 only. Then TDS on winnings from lottery and crossword puzzle was brought in the 1972. And then card game or any other game was incorporated into 194B in 2001. In 2023, further, or from gambling or betting of any form, card game or any other game of any sort, or from gambling or betting of any form or nature whatsoever, being the amount was, therefore 115BB, which is again a section which deals with how much is the tax payable under this. It was 40% earlier. From 2002, it is at 30% flat rate. Tax on winnings from lotteries, crossword puzzles, races, including horse races, card games, and any other games of any sort, or gambling or betting. Whether gambling or betting is legal or illegal is another thing. Insofar as tax is concerned, it is flat rate of 30% now. Because income tax does not distinguish between profits which are legal or illegal. The entire thing has to be brought to tax. Now, from 1/4/2024, the amendment effective, this Finance Act 23 introduced that 115 BBJ, tax on income by way of winnings from online game. Again, it's flat rate of 30%, like we saw for 115 BBH. similar wordings? When you say in winning from any online game, that's very important. Online game means a game that is offered on the internet and is accessible by a user through a computer resource, including any telecommunication device. So it does not necessarily mean only a computer resource. All your mobile phone, tabs, everything would form part of that telecommunication device. So the important factor to be noted here is it must be from an online game on the internet through a computer resource or any other telecommunication device. 30% is a flat rate of tax under 115 BBH. Again, the important thing is on the net earnings. If you look at 115 BBJ 2, the amount of income tax with which the assessor would have been chargeable had his total income been reduced by the net earning winnings referred to in clause 1. So, talking about net winnings, the amount of income tax calculated on net winnings. What is this net winnings? Are you saying that you invested 1,000 rupees to play multiple games? You ended up losing 9 games. And at the end of the day, you have 1100 with you. Is 100 rupees net winnings or something more, or whatever you have lost, it doesn't count, and whatever you have won counts. We'll see that as to what that particular net winnings are. I'm not getting out to what is telecommunication device, so it involves everything. Again, no benefit of maximum exemption limit under 115 BB also. 58.4, there's a specific section which has been there for the last 35 years to say that no expenditure for specified categories for winning from lotteries, crossword puzzles will be allowed. Now, if all of you are aware as to how these games happen and how these platforms lure people into that, they say please register on the website. We'll offer you initial bonus of say 1,000 coins or 1,000 points, as the case may be. You continue to play, or you deposit 1,000 rupees and start playing with us. We will allow you to play for 2,000 rupees. There may be 1,000 combinations in which the platforms and gaming companies may come out with. But what is important for us is what is the net earnings and now how. Like you had 194S as TDS for 115 BBH. You have 194 BA for TDS on winnings from online games. Notwithstanding contain any provision, a person responsible paying by income from way of winnings from online game shall deduct income tax on the net winnings in the user account at the end of the other rates in force. Provided that, what is this here in user account? For example, if you have created your account on say Dream 11, you have your own account there, you invested 5,000 rupees, and you continue to get accumulate points or tokens there, you should be converted into money and it's become 7,000 there. And when you're withdrawing that particular thing, that's a user account. Withdrawing, there will be TDS on that. It may so happen that your winnings are completely not in cash, which means they might have given you a voucher to redeem, saying you can stay in a hotel up to 10,000 rupees. So what happens to that? Are you saying it's not taxable? Isn't it a case of the computation failing and charge failing? No. They've covered it here to say that in case where net winnings are wholly in kind or partly in cash and partly in kind, but the part in cash is not sufficient to meet the liability of TDS in respect of whole of the net winnings, the person responsible for paying shall, before releasing winnings, ensure that tax has been paid in respect of the net winnings. So, before your online gaming companies or portals give you money, they will ask you for compliance insofar as payment of tax on this particular income that is generated to you. So, therefore, there can be little chance of misuse there. Rates in force right now 194 BA rate of TDS is 30%. 271C continues. CBDT has also given some clarifications in circular number 5. The most important thing what I was talking about earlier is what is net winnings? How is it to be computed? Because meaning of net winnings for 115 BBJ is different from what is net winnings in 194 BA. 194 BA talks about in the user account. Because in 115 BBJ, amount withdrawn during the financial year plus closing balance as reduced by non-taxable deposits made plus opening balance would be the net winning. But for 194 BA, it is amount withdrawn from the user account as reduced by non-taxable deposits made till the time of withdrawal plus the opening balance. So there is a little difference in terms of what net winnings as per rule 133 and how it has to be calculated. CBDT has given out detailed clarifications in circular 5/23, which is imperative for us to go through some of them here. Because you have multiple user accounts, though you register with a given PAN, TAN, whatever it is, but you may have multiple user accounts. So the aggregate of all of that would be considered for by one intermediary. For example, Dream 11, you may have 10 different accounts in Dream 11, which may be linked to one PAN of yours. Therefore, all of which will be treated and aggregate will be considered for the amount of computing net winnings. Each user account shall be considered for the purpose of calculating net winnings. The deposit, withdrawal, or balance in the user account shall mean aggregate of deposits, withdrawals, or balance all user accounts. So therefore, it is not a question of you having multiple accounts and able to get over it. It will be aggregated. Assuming you're not able to provide different details, then they will treat it as each account will be treated as a separate unit, and then net winnings will be calculated for each of your user accounts separately. And they've given out a formula. I think of late, income tax is working more on giving the computation formula in this particular manner, like how they've given out for 9B and 45.4 also. They're devising this mechanism to give out a formula as to how you will compute. Net winnings equals amount withdrawn from the user account as reduced by aggregate of non-taxable deposits made in the user account. And to that, you add the opening balance of the user account at the beginning of the financial year. You arrive at net winnings. You'll have multiple situations as to how it happens. How will you calculate the amount? Non-taxable deposits will be not considered. But wherever it is not possible, they will do it for each account and then they will compute it. Moot question will be, when do you consider the amount has been treated as withdrawn? You may have account 1 and account 2 and account 3. Intra-account transfers would not be treated as withdrawals. But when it is moved from your user account to any other account, it may be somebody else's account also, it's treated as withdrawal, or to your bank account. So therefore, when there is movement of your points or token or amount from one account of yours to a different person's account, or you're redeeming it, it will be considered as withdrawal. They've also said any account of user which is not registered with online gaming is an account which is not a user account, and any transfer from user account transaction is a withdrawal. If you have not designated this as a user account, it may so happen that you start the game by paying 1,000 rupees. The company issues some coupons for purchase of goods or some item in kind, that will also be considered as withdrawal, because you put in 1,000 rupees, you're getting back 1,000. You might have blown up this 1,000 and lost the game, but you're still getting back 1,000. That 1,000, the value of that particular coupon or whatever will be added. If you look at the definition, net winnings equals what is there. This will be added to your balance as if you have redeemed cash and then brought to tax. Then they've also clarified that if the deductor is deducting tax for each platform separately, transfer from one user account to another user account on the same online gaming intermediary platform shall be considered as withdrawal or deposit for the purpose of net winnings under 133. Another user account. So therefore, net winnings, we have now seen as to how it happens in the earlier regime also. They have to ensure that taxes are paid on that, on the value of what is being given in kind. Again, non-resident, we have seen what happens in terms of how we have understood as to the status of an intangible asset and with its owner. Similar is the law here. The general law is that the status of the intangible asset would be according to the law of the state which created the intangible property and the interest therein. Now, competitive gaming, you have specialists who are gamers in their own right. They compete in tournaments and win prizes. You have streams like YouTube and Facebook, which allow these games to be streamed, and then they earn money through sponsorship, ad revenues, etc. They will not be included as part of income from online gamings. You will have a promotional video happening, or depending on number of clicks, those will not be online gaming. It is only for when you are having this online game, a person plays through the internet online game, and then it results in him having net winnings. That's when. Otherwise, the other streams of income will be taxable under the head profits and gains of business profession or other sources, depending on what it is. If your predominant activity is this, you will be treated as profits and gains of business or profession. Or if it's an additional stream, which is not your line of business or it's not treated as business, it will be offered as income from other sources. So here, the winnings from VDA will be taxable in the hands of the gamer under 115 BBJ, because there is, in this situation, no consideration flows from the gamer to the gaming company for the transfer of the VDA. However, the winnings will be taxable in the hands of the gamer under 115 BBJ. Again, GST on online gaming, it's a vast subject. I would not go on because I think for paucity of time, I would not get on to how the GST is being imposed and how it is taking up. This is again our income tax rules. This is again GST. I will just touch upon the e-commerce. I will not get on well on to in detail about the equalization levy and other things. Due to different challenges in the digital economy, the OECD and the BEPS Action Committee, as part of its 2015 action report, identified a lot of challenges which come across and how you have to do this, which is why you had this SEP, that is significant economic presence, a test coming in, and then equalization levy is brought in as Chapter 8 of the Finance Act 2016 itself. And then you have, under the local laws, you have 194O introduced by Finance Act 2020 for levy of deduction of tax at source of 1% on domestic e-commerce transactions. Here 194O, this is e-commerce participant and e-commerce operator. TDS will be at 1% on the gross amount of such sales or services. Look at it. 194O. No deduction shall be made. One. Notwithstanding anything contrary, Part B, where sale of goods or provision of services of an e-commerce participant is facilitated by a e-commerce operator through digital electronic platform or facility, then such e-commerce operator shall at the time of payment of credit whatever deduct tax rate of 1% on the gross amount of sale or services or both. Here, any payment made by the purchaser to an e-commerce participant for the sale of goods or provision of services facilitated by e-commerce operator shall be deemed to be amount credited or paid. Because how the situations will emerge is the payment would directly go to an e-commerce participant by the purchaser of goods, but the intermediary who's the actual seller would not be. This will be deemed as if the amount is paid by the e-commerce operator to the e-commerce participant. This is like you have a seller on one of these e-commerce platforms, say in Amazon. You are the buyer, and Amazon will be the operator through whom you're doing it, e-commerce participant. Then your payment will go to the e-commerce participant. Then it shall be deemed to be amount credited or paid by the e-commerce operator to the e-commerce participant. Tax is 1%. E-commerce operator means a person who owns, operates, manages digital or electronic facility. Participant is the seller, as I told you, or providing the services. E-commerce operator will be your generally the platform, say Flipkart, Amazon, etc. Participant should be the vendors who would list their services or goods on the platform of the e-commerce operator. Again, you had issues coming up as to applicability on payment gateway, because the payment gateway will become a e-commerce operator through which the e-commerce participant gets his money for services rendered. So it could have so happened that TDS would have been affected twice. So therefore, if tax has been deducted by the e-commerce operator on the first leg, when the payment or the money is routed through the payment gateway at the second limb, there is no applicability for TDS. I would not get on to equalization levy. I'll just run you through this chart as to TDS, equalization levy, and TCS as to how it moves on. Transaction on which the said tax or levy is applicable is under 194O, sale of goods or provision of services of a resident e-commerce participant to digital electronic platform. 165A and the equalization levy on e-commerce supply with effect from 1/4/2020. E-commerce supply or services by e-commerce operator to a person resident in India by e-commerce operator to a non-resident, both are covered here, or to a person who buys such goods or services or both using IP address located in India. Because it may so happen that you don't know who the buyer is, but if it is happening through a IP address located in India, 165A would come in. Under the CGST, you have a different thing. Every electronic operator not being agent shall collect tax on the net value of taxable supplies. So if you look at a resident buyer in India purchases goods through e-commerce platform run by non-resident, e-commerce operator will deduct tax at 1% from the payment to be made to the seller, and he's also liable to pay 2% as equalization levy. So the conditions are there as to less than 1 lakh a year. All those things are not there. For 194O, you have 5 lakh as the limit. For 165A of the equalization levy, where equalization levy would not be charged if it's already charged under 165. This 165A is not applicable. Or when the sales, turnover, or gross receipts of the e-commerce operator from the e-commerce supplier service less than 2 crore. CGST, of course, they're not dealing with it, but it's applicable to every electronic commerce operator excepting the agent. Person responsible, the rate, 1% of the gross amount of sales or services under 194O, 2% equalization levy on the amount of consideration received or receivable by non-resident e-commerce operator. The CGST, it is not exceeding 1% of the net value of taxable supplies. I've tried to sum up in the last 90 minutes or so as to how the online gaming industry has progressed, the taxability aspects of it, the TDS provisions, and how the digital economy is moving on, and how the income tax has kept up pace with the taxability here by bringing in 165A of equalization levy and bringing in TDS provisions for online gaming and virtual digital assets. So probably we're moving in the right direction. Issues will arise. It's not that there won't be any issues coming in. As and when issues come up, definitely courts will interpret, and then we'll see where it goes. But for the moment, I would thank all the audience for a very, very patient hearing. It's open for questions now.
Thank you, Prashant sir. Now let us take up the question and answers. First question, whether losses from VDAs can be set off against any other income or can it be carried forward to future years?
No, it was as explained. It is not possible. It's a standalone section, self-contained code. Loss of VDA cannot be. But one aspect which I touched upon when I spoke also was, if there is a loss from a VDA before 115 BBH was introduced, at which point in time you would have treated it as either as a business loss or as a long-term capital loss, depending on how you had held it to be. My opinion is you should be able to set off against in the regular streams, not in the VDA. VDA does not allow set off or carry forward. So under VDA, it's not permissible. But if it's before 2022 March, if the loss has arisen, I am of the opinion you should be able to set off not against the income from VDA from 115 BBH, against your regular streams. In your regular computation, against your regular incomes, you should be able to set off, but not under 115 BBH.
Thank you, sir. Is there any tax deducted at source on VDAs and any thresholds on the same?
I think, Sneha, we have explained the entire webinar was about that as to what the section was and other things. So I don't think it merits getting on to reading the slide over and over again.
Rightly said, sir. So we'll move on to the next question.
Yeah.
How are gifts of VDAs taxed?
No, see, the gifts, vouchers, and other things are not treated as VDAs in the first place at all, which was clarified. And it is very clear that this loyalty vouchers, upgrade vouchers, petrol points, and your accumulation of credit card points, what they give you in multiple forums, right? You keep, if you say, for example, buy fuel from, say, Bharat Petroleum, your credit card will have a agreement arrangement with the that company, BPCL. He will give you some reward points for regularly fueling up at BPCL. Are they virtual digital assets? They have clarified that those things are outside the ambit of being treated as VDAs. So they are like any other regular things. Nothing to do with VDAs for reward points, mileage points, loyalty vouchers, gift vouchers. They're outside the ambit of VDAs.
Okay. And for online game winnings, is there any threshold unlike the previous years? Is there any threshold for online game winnings unlike the previous years?
There is nothing for the online game winnings is treated as the net winnings in the user account. So therefore, there is no specific thing brought in. Only the rate of tax which was there and the TDS and the 194 BE other things is at 30% now. But there is no specific number beyond which they're supposed to do it. It is applicable.
Correct, sir. You have already clearly mentioned what includes the net winnings and how the net winnings is supposed to be considered, and a very detailed explanation you have given on that. Okay. And what happens if I lose money while online giving during income tax purposes?
If you say losing money, it means that you lose. Not losing money, which means you've lost the game or you've lost your whatever bet. Correct? which
Yes,
means you
yes, yes.
deposit 1,000 rupees into Dream 11. You think that you have picked the best 11 players, and on that day, they grossly underperform, and you end up paying nothing, you lose.
Correct.
So it's not a case of theft. You've played the game, you've lost it. So you've lost it. So ultimately, if you win the next day, when you compute net winnings, this will be treated as deposit of all non-taxable deposits plus uh, amount withdrawal till the date you compute, and then for the net winnings, it will be computed.
Yeah. Right. Right.
Unlike in VDA, wherein loss from one VDA and another cannot be set off, in the
Hmm.
online game, it is not that. It is not that each game, yeah, the income from each game is not treated separately. You keep playing daily. As long as you don't withdraw, the profit or loss is notional, it is lying in the account. Only when you want to withdraw, then they will compute whether you have made, uh, ultimately you earned money or not. If you have earned, you will end up paying tax under 115 BBJ. Unlike in
Yes.
VDA, wherein the purchase and sale of each VDA, you will incur the purchase, the loss or profit, it can't be set off. But in 115 BBJ, there's something called set off. But if you choose to withdraw, for example, you put in 1,000 rupees first, you win 900, say. So 1,900 becomes your balance. You withdraw 900. You pay tax on 900 that day when you withdraw. And next day again, you put 1,000 more rupees. Your account has 2,000 balance now, correct? You had
Correct.
1,000. You earn 900. You withdraw the entire 900. So that winning of 900 is taxable, on which they deduct and pay you. So next day
Correct.
again, you 1,000 more rupees, you will recharge your wallet. You had 1,000 rupees originally. You gained 900. You withdraw 900. You'll again add 1,000, which means the balance becomes 2,000. Assuming you lose the entire 2,000, it's over for you. You ultimately reach a situation where you have paid tax on gain of 900, wherein in effect you have lost 100 rupees there.
100 rupees.
You've lost, but it depends. If you withdraw, you have to pay tax then there is no set off.
Correct. Correct. Yes.
You have paid taxes. So
Yes. On
ultimately,
the
in
net
your
winnings.
on net winnings, you paid.
Okay. Okay. So the next question is how rewards given by fintech companies is treated as game of skill or game of chance. When the rewardee does not use the offer, how is tax liability?
No, if the unless it is redeemed, for example, any voucher
Hmm.
given, if you don't redeem it, there is no value attached to it.
Correct.
There's no value attached to it, so it can't be unless you redeem it. They can't. But if the whichever it can be fintech company or non-fintech companies, if they're giving you any vouchers, you have to see whether if it is given to their employees, they might have treated it as perquisites, so it might have been taxed as salary.
Correct.
The non-redemption of vouchers given by your employer does not mean you don't pay taxes on perquisites. Assuming a company gives you Sodexo coupons worth 10,000, treated
Hmm.
as perquisites. If you don't buy groceries with it, the company is not responsible. Company will treat it as perquisite and collect tax from you. Whether you redeem it or not is up to you. For
Okay.
companies giving the vouchers, I mean.
Correct. Correct.
For
Yes.
employers, they give it to the employees and treat it as perquisites. So it's already taxed as salary. If you don't redeem, you lose, that's all. There's no set off again there.
Yes. 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 Right, sir. So what if I sell an NFT that is created by myself? Are there any exemptions or deductions available for NFT investments?
There's no nothing. Whatever there is no uh, deduction allowable excepting cost of acquisition. But because it is self-generated, you will not be able to claim capital cost depreciation on the computer. To understand, to rephrase the question for the benefit of audience, it can be that I have a huge computer system which requires elaborate programming and the power and so on and so forth for the minting of cryptocurrency to happen. That capital cost and the consequent depreciation on that is not allowed.
Correct.
It is not allowed. So whatever if you acquired it by paying a consideration, that is allowable as a deduction. It's cost of acquisition, but otherwise the other expenditure is not allowed.
Okay. Okay. I think that's it, sir. We have no more questions. So, on behalf of everyone here today, I want to thank Prashant G. for an insightful presentation on the fascinating world of cryptographic assets, NFTs, and the intricate landscape of their entire taxation in India. So, your explanation of Section 247A was particularly very helpful. It truly shed light on the complexities that has been involved. You have also discussed the CBDT clarifications on exclusions from the VDA, which is worth note taking. We have also discussed the judicial precedents on online gaming. A detailed discussion went into net winnings. So, the discussion on challenges that we are facing about these assets in India is definitely thought provoking for us. You have highlighted the need that we have to look out for more uh, upcoming clarifications from the government in aspect of GST. So, this has definitely given us valuable insights. We appreciate you taking the time to share your expertise and giving us your valuable insight as we navigate the future of these assets. So, thank you, Prashant sir. Thank you, all the participants, for attending this session. And I also thank the Direct Tax Committee for organizing this session and giving me an opportunity to moderate for this session. Thank you, everyone.